biggest reason people fail with investing isn't because they don't know enough, but because the simple answer feels too boring to trust.
It's the trap, right? Most people assume that if something really works, it has to be complicated, sophisticated, or maybe even a little bit stressful.
Today's guest is here to challenge that idea. We're joined by Tom Bernard, author of The Index of America. And this conversation goes way beyond just talking about the S&P 500.
Because this episode is really about something deeper. Why building wealth is often less about finding the perfect strategy and more about learning to trust a simple one.
We talk with Tom about what the S&P 500 actually is, why it's become such a powerful tool for long-term investors, and why so many people still struggle to believe that boring can actually be brilliant.
And maybe even more importantly, we get into the personal side of money: fear, doubt, uncertainty, and what it really means to become emotionally comfortable with investing.
So if you've ever felt overwhelmed by money, questioned whether you're doing enough, or wondered if building wealth really could be simpler than people make it sound,
Then stay with us, because this one might completely change the way you think about investing. This is the truth about the S&P 500 with the guy who wrote the book. This is episode 192 of the Five Guys podcast. Let's get into it.
Tom Bernard, welcome to the Five Guys podcast. Thank you so much for joining us.
Hey, thanks, Chris. Great to be here.
Wonderful, wonderful. Well, Tom, I have to assume you didn't write a book called The Index of America because the most exciting part of your day is looking at some charts. So what made this personal for you?
Yeah, great question, Chris. So I've been curious about personal finance for pretty much my entire life, and as you know, money is critical to all things, and really kind of hit home to me when I was younger, and my parents got divorced, right? And divorce kind of causes a lot of financial trauma in families. And at the time, I was in college, and so that made money just a critical component of my kind of everyday existence. And it started to get curious, learn about it, did all sorts of reading. My family appreciated how much I was learning about it, how interested I got in it. And eventually, as I've got grandparents and as they were getting older, it became pretty clear to everyone that their nest egg just wasn't going to hold out, right? And my family asked me to talk to them about investing and seeing what we could do to kind of extend it. And that conversation just had a tremendous impact on me because these are people that I loved and respected and grown up with. And trying to explain the stock market to them was just really challenging. And while they were, incredibly intelligent and they'd done great, financially, raised 7 kids, had a great nest egg, they were just really scared of the market. They'd lived through the Great Depression and had pretty much consistently just invested in CDs. And after hours and hours of talking around and around, ultimately they ended up just maintaining their position in their CDs. But it just showed me how challenging it was to actually have a conversation and get people to kind of understand the nuances of the market and the potential impact of it, because it is such an emotional thing. You're investing your life savings for them. In this case, was something that they just couldn't really let go of. And so that was the beginning. And over time, I've had an opportunity to have many more discussions. I ended up teaching some personal finance classes at City College. And it just became clear to me that while was very comfortable with the market and investing in it, there are many people that aren't. And I felt like one of the reasons is because they didn't really understand kind of how some of you know, in this case, one of the most common indexes around, the S&P 500, really worked. And so I just started, basically taking notes and clipping articles that I found out about it. And after about a decade, I had a pretty healthy binder of information about the S&P 500. And I thought, okay, this is probably enough to kind of jot down some notes and put it into a book. And so that was the genesis of it, was really to, try and clarify and put down my thoughts on the S&P 500 into a consistent manner that people could kind of pick up at their leisure and also refer back to, because it's really easy to invest when things are going good. But, all of a sudden when the market takes a dive, that's when people really, need to be able to refer back to something to kind of help them stay the course and not jump out of the market at the worst possible time.
Yeah. You mentioned something there, that understanding. And I think we as human beings, when we don't understand something, we fear it, right? We fear what
Yeah.
we don't understand. So from your vantage point, Tom, what do most people misunderstand about the S&P 500? Maybe you can even give a little backstory to our listeners as to what is the S&P 500? Because some people may have heard that term S&P 500, NASDAQ,
Yeah.
Dow, and they're like, I don't know, man. It's green or red. I don't know.
Yeah, yeah, yeah. No, great, absolutely. And those are typically the two biggest indexes that people hear. Maybe three. The Dow Jones Industrial Average 30 stocks, the Nasdaq 100 stocks, and the S&P 500 and 500 stocks. And everyone's really clear. Okay, 30, 100, 500, but they're not at all the same, right? They're very very different. And so I chose to focus on the S&P 500 because it's the broadest stock market index, and as the number indicates, it's comprised of about 500 stocks, um, different companies, and they are generally the largest stocks. It's designed to capture about the top 85% of the value of the stock market. So these are considered large cap stocks, and it started, just a little bit of backstory. So Standard and Poor's, the S&P 500, started with two different companies. One was called Poor's Publishing, which the creator of Poor's Publishing wrote a lot of narratives about the market, and then there was Standard Statistics, and Standard Statistics was very interested in actually the mechanism of indexing and market capitalization weighted, and eventually these two companies merged um, back in the 1940s, and that's when they started to kind of really hone the indexes. And the S&P 500's been around for a long time. Officially, it was launched in the 50s, but it started as early as the 1920s and had been slowly building and changing over time. But the precedent for the index overall started in the early 1920s. One of the things that I think people don't appreciate, and one of the reasons I call it the Index of America, is because it was really designed to capture the economic output and the value of the American economy. And so when this was established, the baseline. So right now, the SP 500 just closed at a record. I don't know what it was, but maybe like, I think maybe 7,200 or high 7,100s today. All time record. But it started with a base value of 10, and that 10 was established over the early 1940s, of about 3-year periods. They took some weekly samples of the market value to establish that 10 base year value. And when it launched in the 50s, the first closing day was around 44. So from its launch of 44 to now over 7,000, that is representative of the growth of the value of American businesses. And one of the great things about the S&P 500 is that it covers many, many different sectors. So there's something called the Global Industry Classification System. It's got more than a dozen different sectors. And so they capture the highest value, most robust companies in each of these sectors. And so as times change, like right now, obviously we know that technology is at the forefront in the index. But if you think back, I don't know, 50 years, it was, kind of large conglomerates and industrials, when companies like General Electric were the big ones, and maybe Kodak, right? So now we have, Googles and Metas and Nvidias. So it changes, and over time, we expect it to change again in the future. But one of the benefits of the S&P 500, because of its broad breadth, is whatever that next sector is, maybe it's financials, maybe it's healthcare, they already own some of the largest, most successful companies in that sector. And then as those companies become more profitable, generate more revenue, et cetera, they become a larger portion of the index itself. So that capitalization weighting is really, really important, as opposed to something like maybe an equal weighting, right? So as the value of that company rises, its significance within the index also increases.
That is a very succinct way of putting that. I think some of our listeners might be surprised to hear that the S&P 500 has a mechanism to kind of kick stocks out and bring stocks in and change. I think a lot of people believe that these indexes are set in stone, and once they're done, they can never be changed. How often are they making changes to these indexes?
Yeah, great question. So there's a number of criteria. As I mentioned, one of them was the size, so the value of the company, and they actually they measured the size about every quarter to establish what is the threshold to let people in, or let companies into the index. Um, and I think right now it's a little over $22 billion, 22.7, I think. But they don't necessarily kick companies out if as that value grows and now a company maybe entered when it was 22, but if they raise it to 28, but that company's now only 25, they're not going to kick that company out. But that bar continues to increase so that the new companies coming in must meet it. And so the question that you asked was when do they kick them out, or what is it, or how often does that change? Technically, it's considered ad hoc, so as needed. And there are many reasons why companies are added or removed. So typically things like mergers and acquisitions. So when two companies merge, right, and now there might have been two, both of them might have been part of the S&P 500, but now only one is. So that'll open up room to allow someone or new company in, and they don't necessarily replace like in the same sector. So if two tech companies merged and now there's only one tech company, there's an opening, they might add a different sector, something in financials or healthcare, for example, wherever they think that there's a need. So and the mechanism that this occurs, how this occurs, is through the index committee. So there actually is a group of individuals, people that are making determinations on what companies are allowed into the index. It's not just a purely rules based. Like there are many other indexes where it's okay. These are the rules, and as long as on these dates, based on these factors, a company goes into the index. The S&P 500 is not like that. There's an index committee that actually makes a determination, and um, as a result of their determination, companies can come in. One of the primary differences of the S&P 500 over many other indexes is the requirement for profitability. So it must be public for a year, and it must show profitability over the 4 quarters, right? So at the end of the day, if you've lost money for Q1, Q2, Q3, but Q4, you've made so much money that it's overwhelmed all the losses from the first 3, you're potentially going to be allowed in, but you have to be public for a year and net profitable um, for that year.
Once they're let in, if they're no longer profitable, are they at risk of being kicked out, or do they give them some grace period?
Great question. So there's no hard and fast rule, but the 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 reality is there's about 4,000 publicly traded companies in the U.S., and these are the largest 500, and they represent the vast majority of the value, about 85% of the value of the U.S. market. And if a company is not profitable, it's different if it's, um, a change, but usually it means it has become profitable and is no longer profitable and is on the decline. So that typically, that company might be ripe for acquisition, or ultimately, if it goes bankrupt, it'll get kicked out. But the the stair step down, so once it can easily be removed from the S&P 500 and get moved down to like the mid cap index or a small cap index based on that the threshold of the actual value of the company. So let's just take this example, $22.7 billion. If it's now on the decline and the market value has gone down to maybe 9 or 10 billion, it might get kicked out of the S&P 500 but put into the mid cap or the small cap index.
Yeah. So you just mentioned a few other indexes there, the small cap, the mid cap. Maybe we're talking about maybe the Russell or something else that you're alluding to there. When people think of different markets, oftentimes we think of maybe the S&P 500 to your point of your book, but why would someone to say want to make the claim that the S&P 500 is the index of America rather than a mid cap stock portfolio or a
Yeah,
small cap?
yeah. Great question. So currently, and the rules have changed over time. It's been around for a long time, so the rules have changed. But currently, in order to be allowed into the index, you have to be a U.S. domiciled company. And there are many ways to determine that, but usually it's not just listed on the index, but where are the majority of your assets? Where's the majority of your revenue driven by? That is ultimately a discretionary call made by the index committee, but their objective is to reflect American companies and the value of the American economy. Now that being said, U.S. companies generate a tremendous amount of revenue from international operations. I think it's close to 40% or so of their revenue is coming from overseas. So it's not just purely US based revenue. It comes from all over the globe, but the companies themselves are American, and the objective when it was established was really to kind of capture the value of the American economy.
Could you maybe explain for our listeners the difference between equal weighted and market cap weighted? Because I think a lot of people, when they
Yeah.
hear market cap weighted, And as a financial advisor, I know that some financial advisors, what they'll do when they know that someone is in an S&P 500 and they're trying to sell them on why they shouldn't be and why they should let them manage it, is they'll say, well, it's market cap weighted, therefore it's not as diverse as you may think it is.
Yeah, no, that's a great point. So before we jump into that, I just want to give a shout out to a professor at Arizona State, um, Henrik Bessenbinder. And he has written some papers. I think the first one was in 2018. I think he just updated it. And he did an analysis of 100 years or so of the stock market. And um, and what he found is that over time, I'll just briefly summarize it. He compared companies from when they went in to ultimately when they went out versus I think it was just short-term treasuries, like 30-day treasuries, right? And he found some overwhelming number, like the vast majority of stocks don't even beat 30-day treasuries and over their lifetime, right? And when you look at the value, the total value that's been created by the market, I think the most recent one said it was something like $91 trillion. There was a very small percentage that of stocks that actually contributed to that value. I think it was 4%. Like it was an incredibly small amount. And this is over tens of thousands of stocks over 100 years. So a very small amount is actually driving this economic value. And so all that is to say that for a market capitalization weighted index, the way that it is constructed is that the value of the company determines how much relative to all of the values of the companies in that index what that percentage is, right? So a company like NVIDIA is going to have a much higher percentage than a company like Chipotle based on the value of it, right? So let's just say hypothetically that it's 7% and half of a percent of the total value of the S&P 500. But in an equal weighted index, both of those will be the exact same, right? 0.25%. And so as the value, if the value of one stock goes up, and they rebalance specifically for the equal weighted, they typically rebalance quarterly. So every quarter they say, okay, the values are whatever they are on this quarter. 90 days later, they measure it. The stocks that have gone up in value, they sell. Okay, so that they can come back down to the equal weight. So they are selling their winners, and the stocks that have not done as well, they are buying so that they can come up to the weight. So they are selling their winners and they are buying losers, right? That's part of the equal weight. Now, as part of this, the mechanism, you are incurring transaction costs. There's bid ask spreads. There's potential tax implications. So it is not generally as efficient as just a purely market capitalization weighted index. That being said, I don't know the differences over, the last few decades between the two, but in general, there are, cost implications associated with an equal weight index that don't exist in the market cap or as much in a market capitalization weighted index.
Yeah, you're exactly right there. Could you maybe tell a little bit of a difference between if someone says like, all right, I guess I understand this S&P 500 thing, but do I need to buy it in a mutual fund? Do I buy it? Is it a stock? Is it an ETF? Like I've heard all
Yeah.
these terms, but I don't know
Yeah.
how to actually get it.
Great question. So let's start with why did I just pick? Like there are a number of great investments. I picked the S&P 500 specifically because there are rules around it and it's generally widely available. It is a highly accessible investment, right? If you have a 401k or you just have a typical brokerage account, there's high probability you're going to have access to an S&P 500 fund. To your point about do I buy it in a mutual fund or an ETF? Uh, Generally, both are available, right? One of the key drivers that I when I discuss with folks is the costs associated with those funds, right? So you can invest in an S&P 500 fund, a mutual fund, or an ETF, and the cost can be very different depending on who's providing that fund. So the company of choice for me is Vanguard, and the mutual fund that I invest in is VFIAX is their symbol, or the ETF equivalent is VOO. It's the same exact basket of goods, the S&P 500, but there's slightly different cost structures. I think the mutual fund is at 4 100ths of a percent, the other one's 3 100ths of a percent. But it's possible to also invest in an S&P 500 fund that is high cost at 0.5% or 1%. So you want to be very cognizant of what that cost is. There's usually a couple other impacts associated with it. One when I started investing was that you could not buy ETFs on a, like a consistent investment plan. So if you every 2 weeks, for example, you get paid, you wanna invest $100, right? I could set that up on a mutual fund at the time. I couldn't set it up under an ETF. I don't know if that's changed, but that was the primary driver when I set up my program.
Yeah, it certainly has. So depending on your brokerage, you can set that up even for an ETF, which is wonderful that we live in a day with technology that we can even buy fractional shares of some ETFs depending on the brokerage that you use. Now, something that I'm thinking about was, as you say that, is if someone decides, all right, I want to purchase this ETF or this mutual fund, or I'm looking at these different ones, and some of them have lower fees, some of them have higher fees, but it's based off of something else, an S&P 500 that's made by other people. Why would why would someone charge a higher fee than somebody else if they're not the ones making those determinations?
Uh, that's a great question. Different companies have different cost structures, physical location, their offices, the personnel, um, et cetera. So I don't know why one company is going to cost more than another, but like any business, there can be different prices for relatively the same good. And in this case, the S&P 500 should be the same good regardless of who you're buying it from. So I would advise trying to select the lowest cost. Now there can be a number of reasons, family, history, other accounts, etc. But it is something to be aware of. One of the good things is now with ETFs, it is typically very easy to purchase a low cost ETF through almost any brokerage, whereas some will have restrictions or limits around mutual funds.
Yeah, I know even some for like a VTSAX, right? The total stock market index. I think it's a
Yeah.
10,000 buy-in versus VTI where you can do it for you can buy a fraction of a share.
Yeah, no, that's a great point that I failed to mention was the entry, right? Like, what is that hurdle for me as a person to just get in? And I think it can be, I want to say $3,000, but for ETFs, it can be, as little as 25 or $50, right? You can just get in, which is great. And really the whole objective as people start to, get curious about investing is to just start. Right. It's really easy to kind of hem and haw and be like, should I? It's an all-time high, but like just get in. Right. Like you just have to get in and yes, it'll go up, it'll go down, but it's like it's a habit and it's also a muscle. And only by starting to do that exercise of investing do you build that muscle, do you build that habit. And it takes time. I mean, it takes decades to get there. There is no, press a button, easy button, press it and you get rich quick.
Yeah, I would definitely agree with that. So, would you say that the S&P 500 is a simple investment? It's an easy investment to make?
Well, it is. It is simple to make. But that doesn't mean it's easy, right? And investing can be. There's uh, as I mature and I have more conversations with my kids, I've got a couple of kids in college, it's easy to do. You think, "Oh, push a button, I buy VOO," but the emotions around it, especially, if you've earned the money and you have, all the emotions wrapped up into what is associated with that money, right? What does it represent, etcetera. So it's very easy to maybe panic if it goes down and you're not expecting it. So I strongly encourage folks if they're going to invest in the market, while it's great to get started, it's really helpful to understand your overall financial plan in terms of, your debt and your emergency fund and, you know, where am I so that I'm not going to have to sell my investments at inopportune times to meet other obligations.
Of course. And how would one begin to do that if they're just saying like, "All right, I want to start to build these muscles, but I don't even know where to begin."
Well, great question. So the first step I think is always educate yourself, right? So whether it's reading books or reading blogs or listening to the Fi Guys, right? Like there's a lot of resources now. I mean the ease with which people can access information is incredible. So I strongly encourage go to the different websites, whether it's the Reddit forums or different websites When I first got started, I spent a lot of time on one called bogleheads.org.
Mm.
So Jack Bogle, the guy that started Vanguard and actually started the first S&P 500 index fund back in the 1970s, that website is kind of named after him, and just read a lot of the boards, learned a lot and understood it, and it's easy for me to sit here today and and say invest in the S&P 500. But the only reason I can sit here and say that is because of all of the mistakes that I have made along the way, the investing in the individual stocks, the picking a sector that you think is hot, or trying to time the market in the cycle of, okay, well, it's low now and it's going to go higher later, thinking that I had I'll say a Teflon emotional base, that when it came down to it and there was a big crash in 2008, realized, nope, right? So I've made just about every mistake there is. I have sold at the bottom. I have bought individual stocks that have gone completely bankrupt, right? Like, so there's a lot of mistakes that have been made, which makes me feel much more comfortable in recommending the S&P 500 to folks than other investments. But it's you kind of have to pay your dues and learn your lessons, and I'd say it's unlikely that someone that's never invested is just going to stick with it. You're going to get tempted. You'll maybe start here. It's a great gateway. It's a great way to get in, and then you'll start with, oh, I'm going to add some different, tweaks, international or more tech or whatever it is, right? And I absolutely encourage people to experiment. You have to learn your own lessons, but um, the key thing is to try and keep a good chunk, in the S&P 500. Maybe not all of it. Go experiment, go have some fun. But if you can keep half, 50, 60% in the S&P 500 and go play with your other 20, 30, 40%, whatever it is, like, you can always come back to a pretty solid base.
Yeah. And to our listeners, always remember that what we're talking about today is for information and education purposes only. So none of this is advice. You have to go and, like Tom said, make your own choices for what you're going to do with these things. So Tom, I'm going to shift a little bit, or instead of just asking you
Sure.
questions as if I don't know what's going on with the S&P 500, I'm going to kind of throw on my advisor hat and let's talk a
Please.
little bit more about why we talked about it. It's simple to invest in the S&P 500, but it's not easy. And I think when
Yeah.
people hear like, okay, it's simple to do, but it's hard for me to trust that this thing is going to continue to do what Tom says it has done.
Yeah.
Why do you think that simplicity is sometimes so hard for people to trust?
Uh, Great question. So I mean, it's always the why. Why? Like, okay, S&P 500. What do you know about it? You know, it's 500 stocks. Okay, but why? Why are these two guys sitting here saying we should invest in it? Right? There's a 500 of a lot of different things, but these 500 specifically, generally out of the 4,000, are large, and so they are very robust in terms of these these organizations have um, robust reporting infrastructure. They are, you know, from an operational perspective, they generally have very professional management, right? Like, it's so that I'll say the team in these 500 companies, each individual team is a really solid top-notch team. And as a result of having a really solid top-notch team, these companies consistently drive earnings, right? And so what is driving this value? When we hear this number 7,000, well, ultimately it's the earnings per share, right? And that those earnings per share, they're reported every quarter. These companies are audited by public accounting firms, so the numbers are kind of validated and stamped. Um, and over time, those numbers consistently have gone up, right? Now, granted, not always. They go up, they go down, etc. But the value, that number is um, reflective of those earnings going up. And what happens is, okay, so right now, kind of the topic du jour is AI, right? Everyone's talking about AI. It's the next great thing. But 40 years ago, AI was nowhere to be found. It was something else. And those companies were driving earnings and it was going up. But now it's, okay, AI companies, and whether it's Meta or Alphabet or Nvidia, like, they are driving earnings based on what's next. And the stock market is forward looking. And so they're looking into the future and they're seeing these companies and the earnings that they're expecting. And I think right now, I want to say the earnings growth is expected to be like 13, 14%, which is really, really high. I mean, the earnings are good, and growing at 13 to 14% is really high. So I expect there to be, the S&P 500 to go even higher as a result of these earnings. But when it's like, when you're baking a cake, what goes in it? You got flour, you got water, you got eggs, all that stuff for the S&P 500, it's the earnings, and the earnings are coming primarily from the larger companies, right? So going back to best inventor, it's just a small number of companies that are driving a lot of the value. And so when you hear everything about diversification and concentration, et cetera, well, the top 10, 20, 30 companies are driving a tremendous percentage of the earnings and hence the value of the S&P 500 as it's reflected.
Yeah. So I'm gonna play the character of the 16-year-old kid, the influencer
Sure.
online who's gonna go, "Well, Tom, I hear what you're saying there. Like, yeah, I can invest and be a part of all of it, but I know that the next sector is going to be AI. So why would I go ahead and buy this S&P 500 thing when I can just go and buy AI itself and then, I'm gonna win. Obviously, I'm gonna win."
Hey, you know what? I encourage. I love conviction and I love curiosity, and I absolutely encourage people to go try it, but just don't try it with everything, right? And keep in mind that the going back to that diversification and broadening, right? So S&P 500, there are AI stocks there, right? It's across these different sectors and the technology communications. There's some AI components, semiconductors, etc. And so if you're making a effectively a concentrated bet, what you're going to get is you're going to get, I would anticipate, greater volatility. Like it all goes to, risk and reward go together. So if you are expecting a greater reward, you need to also expect a greater risk, right? And you need to be prepared to sit with that risk for a long time or long enough until the reward materializes. And that's one of the things like, um, you could be right, but if you're too early or too late, there's really no difference than being wrong, right? So I mean, there's a lot that goes into making it pay off, and that's one of those lessons that you have to learn for yourself, right? No one can tell you and just convince you. But once again, like try and keep some in the S&P 500, and then go make that bet, learn that lesson, and like there's a Warren Buffett, but not everyone's Warren Buffett.
Yeah. Could you maybe tell a story from your own personal anecdote or something that you've heard of somebody, young, dumb, I wouldn't say dumb, I'll just say young, thinks that they know more than they do? Because I know I have my
Uh,
personal stories, I'm sure you do, and you you
so
you were certain, you knew, and
So
then the world didn't follow the script that you had in your head.
yeah, yeah. This is personal to me. When I was younger, I was very into real estate and investing in real estate. And there was a real estate and mortgages and lending and all that kind of stuff. And there was a company called Conseco, and Conseco was the largest lender in the country to mobile homes. Okay, and I thought, "Oh, okay, this is great," that it had taken some hits, and I invested at the time, I forget the exact dollar amount, but for me, effectively, it was all my money. I mean, it was all my money, and I remember having a conversation with a financial advisor and for a long period of time, and they're like, "Oh my gosh, like, you're crazy. What are you doing? We're gonna have to change all of your settings from growth to just pure speculation." Right, on the whatever the requirements were, and uh, I rode that all the way to bankruptcy. So I invested in it, and then it went all the way to 0, but I was convinced, 100% convinced that it was just days away from turning around. So that happens, and then you just pick yourself up, save some more money, and don't do that again.
Is it at all possible, like, say, "Okay, I'm gonna go ahead and put my money into this S&P 500 thing." What if that goes to 0, Tom? Like, what if that goes to 0?
Great question. So that is 500 unique companies, right? And if so there are companies that go bankrupt every day. And some of these companies, these are the largest. It's a much greater likelihood of a company either getting acquired or going bankrupt and getting kicked out of the index and then getting replaced than um, than staying in the index. But the index itself, because it's made up of these 500 companies, won't go to 0. And if something were to happen where 85% of the economic value of the United States was destroyed, there would be much greater issues for everyone to worry about than their 401k or their IRA. But
It's funny,
y
I say the same thing to my clients often where I say, "We're gonna invest in the broad market index, and And they say, well, what happens if it goes to zero? And I say, well, in that case, you should have invested in precious metals. And they say, like, oh, you mean like gold? And I go, no, I mean guns,
Yeah.
bullets, and canned food,
Yeah.
because we have much bigger issues than your 401k if this goes to zero. And
Yeah.
I think that's something that's hard for people to believe, because oftentimes when they hear about those that are good in the markets, those who are good with money, they're actively doing something every day. They're trading, they're making a move, they're making a bet, and they're winning on that bet. But what
Yeah.
you're saying, and what I'm kind of saying as well, is that you can also set up a system that purchase maybe on dollar cost averaging, maybe a big lump sum, but you purchase this thing this one time and you get the hell out of the way.
Yeah. And you just let it do its thing. So so compounding, you know, the rule of 72 and like how long does it take your money to double and all that kind of stuff. So to shorthand it, right? You put $1 in the S&P 500, it quadruples about every 15 years, right? And knowing that, okay, if I put $1 in today, in 15 years it'll be $4, and 15 more years it'll be $16, right? So $1 today could be worth $16 in 30 years. Like that sounds like a long way, but just think about that. You don't have to do anything. You can go live your life, go to school, go get a job, whatever, and like, but just let it sit there. And that is the value of compounding. And I think I forget who said it, but basically the stock market is a great way to transfer wealth from the impatient to the patient, right? So you invest $1 and you just let it sit there and it will grow, and you don't have to do anything, right? And one of the other things that I've done is buy rental property in the past, and I was under the impression that that was all passive, right? And then you buy a rental property and you have tenants and you have a leaky roof or a broken toilet, et cetera, and you realize that it's not as passive as you might have thought. Um, great experience. Glad I did it, and it's in the scheme of things, it's all worked out. But the dollar that's in the S&P 500, I mean, I really don't do anything, right? I'm just going to come and collect 16 in 30 years, and that'll be that.
Yeah.
So
The mission of my company, Monzon Wealth, is to get money out of the way so that you can focus on what matters most. And
yeah,
the reason that that's my mission is that, much like you, Tom, and much like many of our listeners, I also went down every single rabbit hole of how to get rich quick. You know, I did options trading, I did value investing, I've done a lot of different things, and the dirty secret is I was actually pretty good at those things and did make money. But
that's the worst. You're good at it. You're like, oh, okay, let's go.
well, here was the worst thing, is that you go back and I look at the times that I was doing it in, and I look at the S&P 500, and this is what most people don't do, right? You look at what was the benchmark and you see, all right, against the benchmark, I got 1.5% better.
Yeah.
But for that 1% better, I was waking up at 5 a.m. because I'm on the East Coast to try to
Right.
trade. I was sitting there glued to my desk. I wasn't really doing anything else but trying to bring out this marginal percent for a marginal amount of time, versus literally choosing a stock one time, or not a
Yeah.
stock, but choosing an index at one time, whether that be the S&P 500, the Dow, the Nasdaq, whatever your poison is that you want, and then just doing it and going and living my life, because there are so many other things that requires my attention than my investments. And that took me
Yeah.
too long to learn. That's why we're doing this podcast.
Yeah, no, absolutely right, and having that peace of mind, knowing that there are S&P 500, there are 500 companies, there's professional management, it's highly skilled, highly trained, that are overseeing it. They are effectively working for you, managing your investments, driving as much earnings as possible. Then there's also the S&P 500 Index Committee, a team of skilled financial professionals that decide, oh, you're in, you're out. Think about like the coach of a team. Like you have effectively like the all stars in this S&P 500, and then you have a whole nother coaching staff that's picking. Okay, we want to make sure that we have the best player, the best companies in each of these specific areas that are in. And if you're not the best, you're out, right? I mean, they're doing that on an ad hoc basis, but on consistently and regularly.
Yeah. And I think this is the hardest thing about money when it comes to anything, Tom, is that people can sit there, we can math it out all day. We can sit there
Right.
and show that, hey, the average stock, the average financial advisor, the average financial professional can't beat the market for on average more than 10 years. And then when you take out their fees that you pay them, they've like literally never won before, ever. If, in fact, there's a story about Warren Buffett where he invests, or do you want to tell that story about Warren Buffett where he challenged a bunch of hedge funds against the S&P 500?
Uh, sure. And I might mess it up a little bit, but the gist of it is that um, there was an individual that heard Warren Buffett say that, invest in the S&P 500, it's the best investment around, and this individual was a hedge fund manager who managed like a hedge fund of hedge funds. So like this hedge fund invested in like 5 or 10 different hedge funds. And he basically said, "I'll take that bet." Right? I think they bet $1 million, and they had some insurance program where they said, "Okay, I think it was over 5 or 10 years, and here's the date that it starts and the date that it's going to end." And it wasn't even that long. I think the first year the hedge funds won, but after like the third or fourth year, like it wasn't even close, and there was no way that it was foreseeable that the hedge funds were going to catch up. And a lot of that has to do with the costs, right? The tyranny of costs. And you cannot overcome the money that is taken out of all the investments, right? And so the typical, I think in this case, the hedge fund fee was like 2 and 20. So when it went up and the hedge fund made money, they got 20% of the upside. And every year the annual cost was 2%. So if you had invested $100, they'd take $2 every year. And that cost versus just the low cost of the S&P 500 index was, even if the returns were the exact same, it would never match up because of those costs were just so high. And so that was the gist of it. And I don't think anyone has taken that bet again.
Yeah.
Right.
I,
And one other point. There's a report that's put out by S&P called SPIVA, which is S&P versus the active funds. And so they've now been doing this for a number of years, I think over 20. And one of the largest issues in the marketing of funds, it's what's known as survivor bias, right? Literally there's 4,000 companies in the public traded companies in the US, but more than 4,000 new mutual funds, I think, come online every year or exist. And so there's just this constant churn of mutual funds being created. And the ones that don't do well just kind of die and go by the wayside. And then the ones that do well, they get all the marketing. So you'll see the marketing, oh, in the last 12 or 24 or 36 months, whatever the fact pattern is, it's beaten this very specific thing. And you'll see dates like, oh, from like March 17th to April 9th, like this was the return of the S&P, and this fund beat it by a lot. So that what this SPIVA report does is it eliminates the survivor bias by taking the snapshot of all the funds that exist each year I'm assuming January 1, and it tracks them over time. So even when these funds go out of business or get merged in, they still kind of keep track. And what they've found is that um, as of, I don't know, it's mid 2024, maybe 2025, over a 20-year period on an after-tax basis, the S&P 500 had beat something like 97% of the mutual funds, right? Like there were a couple, but not even like a coin toss. Kind of like there's going to be some, and there's no way of knowing at the time which mutual funds are going to be that 1, 2, 3%. So all that is to say that the costs are critical, right? When you have a handful, going back to best inventor, when you don't have like 3 or 4% of the companies that are driving the vast majority of the value, picking those companies, it's really hard to do, right? And if someone tells you that they can do it and that they can do it consistently, and that, yeah, I did it last year, so I'm going to do it for the next 10 or 15 or 20 years, like be very skeptical, right? And the reason why broad-based index funds work so well, whether it's the S&P 500 or the total stock market, is because you are effectively buying the haystack, right? You don't have to find the needle. You're buying the haystack. You know the needle's in there somewhere, and you're going to get the upside. Because while a stock can go to zero, right? Absolutely. It can go up not just 100% or 1,000%. Look at NVIDIA. It's gone up tens of thousands of percent, right? And as long as you own that index that it's part of, you will ride that wave.
yeah. One of the hardest things when it comes to money, it's not the math, but it's the mindset, it's the behavior.
Mhm.
And we as human beings, we live in relation to one another. So one of the hardest things I think for people to purchase the S&P 500 and hold it for a long term is well, what am I going to tell my buddies that I'm doing that's really hot and sexy when I'm on my boat? How am I going to
Yeah.
tell them about the new stock that I found if I'm just buying the S&P 500?
Yeah.
How did someone get away from that?
Well, it's hard, right? So the behavior aspect of it is hard, and everybody's got an ego, and they all want to tell the story and or impress the person, whoever it is, right? So I get that, and that's why I go back to we're all human, and we far from perfect, right? And you don't want to be, um, you know, tied into something that prohibits you from having a little bit of fun. So once again, like keep the majority of your assets in the S&P 500. It's great. It's going to make you money and it will build wealth, right? Like the objective here is to build wealth and make money not an issue for you or your family, right? But I get it. You want to have some stories, you want to tell some, talk about some of the latest and greatest things. Sure, set aside some fun money, whatever it is, but make sure that you are disciplined in that approach, and that yes, this is the amount of money. Think about it like maybe going to a casino. Like this is the amount I'm willing to invest in this special project or whatever it is, this or lose, and everything else is off limits, right? Because we're only human.
Yeah.
There's
And what I'll say to that, and this isn't to make myself like look cooler, but the thing that makes somebody really cool is when they don't care. When they can just say,
yeah,
"This is what I'm doing," regardless of the way that you choose to judge me.
yeah,
I'll bring up a story on this one. I remember one time I went to Washington D.C. and I was hanging out with these people. We were on a yacht and we were sitting around and we're talking about money, and they came up that I'm a financial advisor, and everyone started throwing off like, "Oh, I'm buying this, I'm buying this, I'm buying this stock, this stock. What do you think of this?" And I told them, I literally don't know any of the words you guys are saying to me. Like they're just
yeah,
throwing ticker symbols at me. And I was like, I don't know any of them. And they're like, well, what kind of advisors are you? Are you even good at what you do? I was like,
yeah,
well, I think I'm okay. And they brought up like, well, then what do you invest in? I said, well, I just buy the broad market index. And they're like, well, that's dumb. Like, why would you do that? How is it going to go to the moon? Like, I have this thing, and it's going to go to the moon tomorrow. And I was like,
yeah,
that's fine. I hope it really does for you. But what I'm doing, it's working for me. And quite frankly, I don't have to think about it. Like,
yeah,
you guys are here talking about this stuff, and I'm talking to my wife about what we're going to have for dinner tomorrow or have a dinner for tonight. And that's
yeah.
really, really cool for me to not have to think, to have that simplicity. Sometimes the greatest discipline in life is not adding more, but taking more away.
Yeah, no, that's a great point, and once again, it goes to the behavioral aspect of it, right? Like that's a very secure position that you're able to have that conversation, and there are so many emotions that can be wrapped up in money, right? Especially relative to one's peers or one's friends, and you want to feel like you're part of the in crowd, or it is really hard to be willing and able to kind of stand apart. But to the extent that you can do that, that's fantastic, right? We'll call that the gold standard. But then there's everybody that can't quite be the gold standard, and so you just have to figure out what are the guardrails that they can put in place to prevent a catastrophe, right? So that they're not kind of blowing themselves up.
Yeah.
And that's why the small, the segregated fun money can be can that little bit of a release valve to let them let off some steam and make poor choices, because I mean that's what we all learn from making poor choices. And so I'm encourage curiosity and experimentation, all that kind of stuff, but do it in a consistent and a meaningful way. And you made a good point earlier where you actually went back and looked at the returns and you compared them, right? So I challenge people, hey, have a thought, have a thesis, write it down, put a date on it, and then write what you expect to happen, right? And then when that date comes around, what happened? Measure it and measure it against the S&P 500 and just see what happened. Like what does reality bear out? And over time, you'll reach your own conclusions, and maybe you're fantastic. Maybe this is the way to go for you, but maybe you might learn other lessons that you didn't quite expect.
Yeah. And I think for that, the most important thing is to be honest. And I think many of us were like, oh, I'm honest all the time. But the person that we probably lie to majority of the time is ourselves, because
Oh
it's
yeah.
so damn easy to lie to ourselves, to give us a little bit of an out. And I'll tell you, when I went back and I looked at my performance, I was like, no, this is wrong. This has to be wrong. Like I
Yeah.
put in so much effort. This can't be right. It took me years to come to the conclusion that, oh my God, I was that dummy that just lied to myself and believed my own stuff. Like I,
Yeah.
I made myself the poison and I ate it and I told myself that I was smart as I was doing it.
Well, and then there are so many ways we can fool ourselves. So you look at it, and you might think, "Oh, my results are better," but then what did you value your time at? "Oh, well, I valued my time at $0 an hour." "Oh, well, what about taxes for all my trading?" "Oh, I didn't factor in the taxes." Right? Like, "Oh, okay." Right? Like, so if I as long as I don't factor in any of these other potentially relevant costs, then I've done great. But, like, to your point, it's really easy to kinda pull the wool over your own eyes, right?
Yeah.
Holding yourself accountable in all areas is really important, and that's why, um yeah. Yeah. That's why I encourage the consistent standard, broad-based S&P 500 index so that you can focus on the other areas of your life to, um, you know, to go and have exciting times with. It shouldn't be investing.
Yeah. And that's what I love there is what you said, it doesn't just apply to investing. Like, it was Miyoda Masashi that once said, the one who sees the way broadly sees it in all, or knows the way broadly sees it in all things. So once you see this truth in investing, you can see it in other disciplines in your life that, oh, maybe I'm lying to myself in investing. Maybe I'm lying to myself about my gym routine. Maybe I'm lying to myself about how good of a husband or a wife I am. You can really start to see that you might tell yourself one story, but there is a truth out there that you're probably not accessing in any way, shape, or form until you're willing to really question yourself.
Yeah, no, that's a really good point, and we have so many ways to self measure now, like whether it's fitness and like the smartwatches or your returns and all the information that's available now online. But what I've found it's been really helpful is just writing it down. If you can develop a practice of just consistently writing down what you think and then referring back to it, and okay, this is what I thought, this is what I thought would happen, and then what actually did happen. You'll realize that there was a gap there, and the more you do that, that gap will close over time eventually, but it could take a while.
Yeah. Why do you think that being emotionally comfortable is such a big deal when it comes to investing for the long term?
Oh, that's a great question. So you hear it all the time, right? Fear and greed, right? This is what drives the market, fear and greed, and so those are very powerful emotions. And the all the cliches or the adages, right? You buy when there's blood in the streets, right? Because there's so many people that are scared. It's going to be a good buying opportunity, and so to the extent that you can um, be a little bit stoic about it and just have a plan in place or a methodology that you follow consistently, you'll be better off over time. It's not always easy to do, but like you mentioned earlier, like the dollar cost averaging, you have a lump sum and you put in a little bit of money consistently every week or every month, whatever it is, or maybe every paycheck, right? You buy the market when it goes up, when it goes down, and the key is to stay with it and consistently hold on to it, not panic at the bottom. I think that's really the trick, right? I mean, there are like I told you earlier, like 2008 came around and I bailed out, right? Like um, I just finished business school. I had a bunch of student loan debt, and I was like, you know what? I'm going to pull the ripcord and clear all that because then I know that that's certain, right? Like I've now eliminated that kind of risk from my life. And yeah, I took a hit and all that kind of stuff, but it was worth it to me to eliminate that risk. And so, was it the right thing to do? The wrong thing to do? I mean, I still look back and be like, wow, if I had just left it in, right, we would have had this huge pile of money, and that would have dwarfed any of the debt, payments over time. But like, we're emotional beings, and there was a part of me that was very fearful in that case. My fear was much stronger than my greed. My fear of being stuck with this debt was much stronger than my desire to have a big pile of money in 10 or 15 or 20 years. And as a result, I was like, okay, this is what I'm doing. Um, and that was the right answer for me. But the objective is to just understand what your future needs are for money, and that's what we talked a little bit about, making sure that you've got an emergency fund or cash, or understand your debt positions or your plan to kind of satisfy some of those things um, over time, so that you're not stuck in a position where you have to bail out at an opportune time. And it's easy to sit here during good times, so like the market's at an all-time high, and think, oh yeah, I've got Teflon emotions. Nothing's going to impact me. But then all of a sudden, if the market goes down 30 or 40% or 50%, and it never happens like overnight, it happens over months or a year. But like if all of a sudden in a year you think, oh, I have half of the amount of money as I thought I did a year ago, right? Like you start to look at the world in a very different way. And so that's why it's important to I'll say have that balance of not only the stocks, but the fixed income or the bond allocation, as I'm sure you counsel your clients, so that you can weather those storms, right? Like I like to sail, and so there's for sailboats there's this big lead keel at the bottom, and it helps to keep the boat upright and from skipping across the water. And the sail will help kind of make it go. You need to have both. You need to have the sail and the keel, because if you just had the sail, it would kind of skip along the water, and you wouldn't really make as much forward progress as you could as if you have the keel to kind of keep you on a steady path.
That's really interesting. I didn't know that about sailboats, so thank you for teaching me about that.
Yeah.
I like to go back and double click on fear and greed. Warren Buffett said that those are the emotions of the stock market. Why do you think that these two emotions, fear and greed, pull so many people away from strategies that actually work?
Oh, um, I don't know. It's instinctual. I mean, I almost want to say it's like fight or flight, right? You having lived through it. It doesn't matter what I thought. I mean, I have literally had a written investment policy. I will do X, blah blah blah. Here's all the stuff, and then something happens, and it could be things that you did not prepare for when you wrote that. There's a life change. You've had a kid. Someone's gotten sick. Whatever. There's unexpected stuff, and while yes, you can in theory plan for that financially, there's a cost, etc. There's also an emotional aspect to it, right? That you might not have realized at the time was going to be as significant to you when you either reviewed your policy statement or thought that you could maintain it. And that's just part of learning and growing up. Like like I said, I've got a couple kids, and there are things that I would, if you'd asked me before kids, I would have told you one thing, but then after kids, it's completely different. And there's no way I would have known that until, I had kids. And and the fear and the greed is part of it. Trust me, I might have been much greedier before kids, and then after kids became more fearful in terms of making sure I was able to provide for them, right? So those are just some examples of over time your emotional needs change, right? As an individual and for the people in your life.
Yeah, I think so many people want to say with certainty, I know what I would do in this situation.
Uh,
Tom, I'm a jujitsu instructor. And so I've
Okay.
been teaching jujitsu for a while now. And something that I get a lot when, especially with the newer guys that come in white belt right off the street, and they'll say like, "Oh, I know what I do in a fight. Like, I'll just see red and it'll be over." And it's like okay.
Yeah.
And those are the guys that get choked out the fastest because yeah, they saw red and then it was over. Like it was done for them. Um, but you don't know who you are until that situation comes up. And you don't no one does. Like even you can talk to fighters, you can talk to
Yeah.
soldiers, you can talk to police, fire, whatever. They're going to say, when that instinct kicks in, when your emotions come in, most of us don't look back on them on our worst moments with like, oh yeah, I did everything right, like I would do all of that again.
Right. Right. There's a it's one thing to think like, okay, I've seen the movies. I know what I'm supposed to do or whatever, right? Like, I'm going to be this guy or whatever. But then when you like you said, you're a jujitsu instructor, and so you must train all the time, right? Daily, maybe several times a day, but hours, thousands of hours, right? Like in the same moves and the same thing, and this and when X happens, you do Y, and you've done it again and again and again, and in many of those instances, it's like the people that behave the right way aren't thinking about it. It's that they have trained so long and so hard, they can do it automatically, right? And the as investors, we don't train long and hard like that, right? Like that is not that there's not an investment program like that that says, okay, get up every day and imagine your money, you just lost half your money, right? Like that's not something that we do. And how would you react? So it's really hard to know until you're in that moment. And then, there whatever else is going on at that time is going to have a very real impact, right? And like it's not in isolation. So I think that the fear and greed, it's easy to put those two names on it, but to understand all the factors that drive the fear or the greed, like that is so dynamic, and that's why it's really hard to know, one, not only how you're going to respond, but what position you're going to be in when that event occurs, right?
Yeah.
Because I've heard several examples of it. Like when things go wrong, they never go wrong in isolation. Like you don't, oh, I just lost the value of my 401k just went down. No, it's usually like, oh, the value of your 401k just went down. You just lost your job, and you also lost your house. Right? I mean, like things, a lot of things will kind of compound and go wrong at once, and then you're like, okay, what am I going to do? Right? Because that was not on my bingo card when I said, "Oh, I'm gonna do X, Y, and Z." Right? So it's really hard to know in advance because they can cascade and compound in such significant ways that unless you've gone through them or seen that, it's hard to know. And so in general, I think people should opt for err on the side of conservatism over aggression when possible, right?
Yeah.
Because it's really easy to think that you have a risk tolerant perspective, but it's much easier to live through a downturn if you've established a conservative position.
Yeah. Everyone thinks that, oh yeah, I'm very aggressive when things are going well. But the moment things go the opposite way, they were like, oh, I've never said that I was aggressive. I never said that at all. You know,
Yeah,
I say that I train in order to be the person that I want to be in when the moment comes. And just like you said, when it comes to investing, one time I was at a bar and a fight broke out, and what did I do? I froze. Like I didn't know it. I just got the hell out of the way. Like I'm not going to be a part of this. I just left the bar. And you think that you would be the person that you told yourself you're going to be, but you don't know who you're going to be. I think many of us, when we think about the stock
yeah,
market, we say, hey, if it went down 50% tomorrow, like that's a great buying opportunity. Like I would do that.
yeah,
And yes, if you woke up tomorrow and everything was exactly the same, but the stock market was down 50%, then go for it. But if the stock market is down 50%, it's because we have a sickness that looks like it's going to destroy the world.
yeah,
Housing just collapsed. A plane just flew into some of our towers. Like there is an
yeah,
event that is tied to it that makes the world seem like this time it's different. That's the idea of a black swan. Something you can never see coming. Therefore, you can
yeah,
never anticipate it. Therefore, you can never even begin to plan for it. Because if you could
yeah.
plan for it, you would have planned for it and it wouldn't have become an issue.
Yeah, there's a story, and I don't remember what culture it was from, but the gist of it is that they were, this community was going to build some houses, and they said, okay, you have to build the houses above this mark on the wall, and somebody asked why, and they said, oh, because that's the highest this valley's ever flooded. Right, and so you build it because that's the highest it's ever flooded, so they built all the houses, and then sure enough, a decade or so later, there's a flood, and it wipes out all the houses because they had planned on the last disaster, but not necessarily on the next disaster, right? So you never, even if you have some information on what's happened in the past, you never know what's gonna happen in the future.
So your book, The Index of America, who is this book really for, Tom? Brand new investors, skeptical investors, experienced people who just want a deeper framework.
Yeah, great question. So I'd say this book is designed for the people that investing is not their main thing. They're not professional investors. They're not going in and investing money every day. But for the people with 401ks, the teachers, the even the kids with the summer jobs and what should they do with their money, put it in the S&P 500. This book's designed to kind of explain how it works, why you should feel comfortable with it, and as it goes up and down, why you should continue to hold on to it, but why over time, over many, many years, decades, it will continue to go up as the companies get refreshed and the American economy continues to evolve and lead the world in innovation. So right now, what we're looking at, we've got 500 of the largest, baddest companies around, right? But these companies were started years ago, right? And one of the things that allows these companies to grow here is the fact that we have such a robust and deep capital market and venture capital infrastructure so that we can really support the innovation and fund all of the ideas that come around. And sure, most of them fail. The vast majority of these startups fail. That's to be expected. But some of them don't, right? And they become the next Google or the next Meta or the next, you know, SpaceX, right? So they are some of them become very, very successful, and we are able to benefit from them. And eventually, they will become part of the S&P 500. So you don't need to get in at the ground floor to be successful. You can just benefit from it after it's been proven out.
You mentioned something there that I'm going to take this to a kind of a global macro level. Betting on America by betting on the S&P 500. For those who listen to the Fi Guys, they're going to know my thought process as to we're in something called a Thucydides trap with China. And some people may look at the world order and say, well, America may no longer be the dominant hegemon of the world. And if that's the case, what does that mean for my portfolio in the S&P 500 if we aren't the top dog, if money and everything isn't flowing through us first primarily?
Great question, and by no means am I a geopolitical analyst or anything like that, but I have confidence the, um, in the ecosystem that is America. So when you look at, um the rule of law that we have, right, and the protection of intellectual property, when you look at the common currency and the population that we have to test things, and this is important because we have 350 million people, one set of laws, very deep capital markets that allow people to try out new things, right? And we have, even though it's one country, we have a vast array of people in different climates, geographies, mindsets, etc. So it's great for testing, right? Like it's a great environment to try new things. And then we have the public markets that can actually take it to fruition, right? Um, other countries have tried to replicate the system that we have and have not been able to. When you look at um, new venture money, it's I don't remember the exact numbers, but the amount of venture money invested last year in the U.S. dwarfed the next 4 countries combined. Like, it wasn't even close, right? And so last year, that money went to start some companies, right? And way more companies were started in the US than were started in these other top 4 or 5 countries, China being one of them, right? And over time, consistently, I believe that will continue to kind of bear out and be reflected in the companies as they come to as they do go public, ultimately get into the S&P 500. So I think that the the path ahead the path ahead is looking good given all of the investments that we've made to date, and I fully expect that investment to continue in the future.
If someone heard our conversation today and said, all right, Tom, you got me, and they wanted to either start or even simplify their investing life, what would be the first step?
I would recommend, going to vanguard.com and opening up a taxable brokerage account and investing some money in the S&P 500 and some in just their money market account. Those are the 2 things that I recommend, and to start off, just equal. Every time you get a paycheck, put, you know, 50 or $100 in one and 50 or $100 in the other, but just do that, and if you invest equally in the cash fund and the S&P 500 fund, what you'll find is that over time, the S&P 500 fund will continue to grow, and you'll also build that emergency fund. And then you can see for yourself, okay, what is actually happening? Because the investments will be equal. The amount going in will be equal, but in a very short period of time, 3, 5, 10 years, the amount in the accounts will be significantly different.
And to our listeners, please remember informational, educational purposes only. You guys have to do your own research. Don't take anything that Tom says or even what I say as gospel. You need to go out and you need to test and you need to check. So, Tom, do you think that the S&P 500 is really just a financial tool or more of a story about American business and our ability to adapt to what's ever going to come down the pipe?
Uh, Great question. I think that it continues to evolve and reflect the success of the American economy and the resilience of American businesses to just not only deliver goods and services that the world wants, but also continue to kind of reach into the future and create what the world wants.
One way I've always said it is that I believe in this country because no matter what happens, no matter what's going on in the world, no matter who's in office, who isn't in office, no matter what's going on, there will be people that will wake up and say, what can I do to make this world a little bit better? and they're going to go out and they're going to try their best. They're going to fail. They're going to succeed. But their goal is to make the world just a little bit better, to make things a bit more right. So, Tom, when we originally spoke before we came on the podcast, you said that you wrote this book for your kids. What do you hope that your kids are going to understand about money after reading this book?
That money is a tool that can be used to create value in the world for many different people, and that um, you just need to you need to plant the seed, water it, and let it grow. But you should be able to go and live your life and not have to be so focused on money that's all consuming for you. The objective here really is to allow this investment to be passive and effectively grow in the background while people can go and live their lives and create value in the world for others and be fulfilled, right? Not something that where it's all consuming.
Tom, you've been so gracious with our audience, with myself. I'd like to give you the podcast. Is there anything that you want to cover before we come to a close, and I give you it to shout out everything that you have?
Uh, oh, thanks, Chris. I appreciate it. I really appreciate you taking the time and allowing me to be here. Um, but, everything that we've talked about and more is covered in my book, The Index of America. You guys can go to my website, indexofamerica.com, and take a look at it. Um, if there's, there's a contact button. If you have any questions, please feel free to reach out. Would love to get your thoughts on it. It could also be found on Instagram and on YouTube.
Perfect. Where do they find you at Instagram and YouTube, Tom?
Index of America is the handle on both Instagram and YouTube.
And we'll have a link down in the description for our audience members. Tom, thank you so much for joining us. Before we close, I do have one final question for you.
Sure.
Obviously, our podcast is called The FI Guys, and FI stands for financial independence. And what I've discovered, and what Dominic has discovered after doing this for a few years now and meeting with so many people, is that financial independence means very different things to different people. So, Tom Bernard, what does financial independence mean to you?
So for me, financial independence means not having being in a position where money doesn't dictate your your actions. Obviously, it's a tool. We need it. It's a necessity. We live in a capitalist economy, but being literally independent, so that if I have a job, but if my job ended tomorrow, things would be okay, right? So being financially independent, it doesn't necessarily have to mean forever, but it means that you have to be able. Being financially independent means that you have enough investments or enough of a nest egg that you can make your own determinations and choose to walk away from situations that you don't want to be part of. And I think that's really powerful um, and something that everyone should strive for, so that you can um, continue to live the life that you want to.
Yeah. I think that's a beautiful point, that financial independence doesn't need to be that you never have to work again, but it could just be having enough breathing room to when the situation arises that you can't foresee, that you don't have to react, that you can take a second to not have to let whatever your base instinct is, because like we talked about earlier, most likely it's going to be the wrong instinct.
Yeah.
So, Tom, thank you so much for joining us here on the Fi Guys podcast. To our listeners, I hope you got some value out of today's conversation. If you did, please like, subscribe, but most importantly, please take the episode link and send it to one friend in your contacts. Share what Tom brought to us today with them if you think that it'll help out. So, Tom, thank you so much for joining us. And to our listeners, we'll see you again next week.
All right. Thanks a lot, Chris.
This video podcast is sponsored by Monzon Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the host and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monzonwealth.com.